But there's other people whose long-term is, the dollar's no longer the world currency. We're all owning gold and living in, in
from
a cave.
Peter Schiff.
I'm not
quite
I don't
the
even
extremist.
I don't ever count out America or Americans.
What's up, everybody? So I'm here with Fred Hubler. Today is March 30th, 2020. We're in very interesting times right now. Real quick, I'm going to introduce Fred here. Fred, and I'm going to read off his bio here so I don't mess up, but Fred is an accomplished senior executive with more than 25 years of success, spanning financial services and technology. He is responsible for founding Creative Capital Wealth Management Group, growing the firm to over 11 states, and building a retainer-based wealth management program. Fred is an innovative leader with a keen eye for unique solutions and a vast knowledge in alternative wealth creation strategies. He received a Behavioral Financial Advisor, BFA, certification as of July 2018. Fred built a framework to allow third-party experts to collaborate with and assist his clients, a practice now spreading throughout the industry. And he is an inspiring leader who draws from the breadth of knowledge in market leadership, business development, goal execution, and wealth management. Fred attained his MBA from the University of Phoenix and his BS in Business Administration from Westchester University of Pennsylvania. As a seasoned board member, Fred has held board positions with Phoenixville Regional Chamber of Commerce, the Andy Talley Bone Marrow Foundation, Rotary, Kiwanis, LGBT Equality Alliance, the Phoenixville Senior Center, Cornerstone for Hope, and the Westchester Schools for Business Advisory Council. He is married to Elizabeth, has 8-year-old twins, James and Abigail, and loves Eagles football. His hobbies include technology, cigars, and cars. Fred, does that sum it up?
That definitely sounds impressive, whoever that guy is. Thank you for having me.
Yeah, absolutely. Is there anything else that you want to add on to there? Anything special that maybe might have been updated recently?
Sure. So I have two hats on. One is a chief wealth strategist for our company. So I'm the guy that they all look to know where we're going. And that's what I want to talk to your listeners about, or, your viewers. The second thing is I'm a business owner. I'm a small business owner. I have 2 businesses. I have staff. And I'm a real estate owner. So I'm kind of living through the COVID-19 that everyone else is living through, but I'm doing it compartmentalized. Like there's different opportunities and issues depending on which hat I go on, which probably isn't any different than any of your viewers or yourself.
Right.
But I'm more than just the one thing. And it sounds like I have a very corporate, business, but I'm the it's my business. So I could call myself president, but it's still a small business in my mind. So sometimes you want to have that, Fortune 500 company behind you, and other times you want to be nimble. And I think we're all going to figure out who, when the tide goes out, we get to find out who has their swim trunks on.
Yeah, absolutely. Well, you mentioned coronavirus. So we are in a very interesting time right now. For listeners who might not know, which might be 0% of the population, we are currently being crushed by a worldwide pandemic. Today, as of March 30th at 10 a.m., we have, across the world, we have 739,385 cases. 35,019 people have died. 156,588 have recovered. Compared to 2 weeks ago on March 15th, we had 169,000 cases. So significant growth there. I will say, looking at the numbers, I think today might have been one of the first days where we didn't have quite the growth that we've had recently. So that's positive, but still we're not really close to the end of this yet. So jumping in, Fred, first and foremost, I know that you're a financial advisor, you're managing wealth for people, and can you tell me about something? I mean, I know that you do some 1031 exchanges. Has there been anything that has really impacted you significantly with this coronavirus? I mean, because we're seeing shutdowns.
So a year ago, I was brought in to help a family who had a $20 million mobile home park, and they were getting out. At the end of the day, the parents were in their late 70s, and They came to us because we specialize not in just 1031s, which, for your realtor listeners, it's one headache. It's Latin for I'm exchanging my headache for a new headache, and you're exchanging your headache for my headache. At where we get in is an institutional 1031. So you still sell to whoever you want to, but then you get into a 1031 of a fractional ownership of, it's a DST, Delaware Statutory Trust. But long story short, it's almost like a REIT to the end user, to the seller. So they sit back and get 5-6% on their equity, and they don't have anything to manage. And almost every time they're getting a bigger property, bigger, better tenants, multiple diversification. So for this client, we were looking at a bunch of different multifamily home, apartments, but some that were being built, some that were already built, and they were redoing it just like they do in HGTV. But it was going to be a portfolio of all these things. And ironically, the buyer of the mobile home park was Carlyle, who's a private equity firm that we use. And private equity is one of those asset classes that your viewers need to be looking at. And we'll talk a little bit about on your show, is where are the opportunities? I mean, there's a lot of bad things in front of us, some we don't even see yet, some we can kind of extrapolate. And that's as assuming the bad thing of someone who was alive is now dead, and they had a family, and they had, that's horrible. And then for the rest of us that are still here, there's still other things we need to be prepared for. So Carlyle, yeah, and we got to respect that, but we can't let it knock us down, or else we're going to get run over. You can be on the right track, and if you don't move, you're going to get run over. So long story short, this was one of the biggest deals that had ever come up to me. And I'd like to say I worked really hard for it. I got a phone call and said, hey, we know you do this. Would you like to take a look at this deal and help us? So it was out of nowhere. I couldn't put it in my business plan. And so, all of us have the ship coming in. Well, now my ship is kind of turning and it hasn't yet gone away. But the Carlyle guys, the guys that actually appraise their purchases, can't get out of Seattle. So that's door number one. Door number two, wearing my hat as a fiduciary, most of the DSTs that are out there today, the company bought them 6 months ago. They had to buy the property, and they had to structure it, and they had to register it, and they had to do all the things they need to do to securitize the property into a proper DST, so that when you do the 1031, you're keeping all of those tax benefits. You can't just buy it today and start getting people, hey, come on in tomorrow. So there's no way that a pre-COVID purchase price is what it's worth today. Yet the statements will all say, well, it's worth $80 million, or we paid $80 million. That number to me, I'm not comfortable with. And the second thing, and I think this is the most important, the rent rolls. The rent rolls of something 6 months ago is not what it's going to be going forward, depending on the property. So if you have multifamily and it's all lower income people, they're not paying the rent. If you have multifamily and it's all Amazon workers, they're going to pay the rent. Amazon's probably one of the things that are, doing really well. And there's a lot of warehouse space that is, on the books and can't be built fast enough. So there are some pockets of opportunity. So long story short, I don't have so good news for me, Carlyle postponed the settlement. So that gives me time to find something in my mind post-COVID, purchase price, post-COVID, rent rolls, maybe even a little bit more, instead of being all multifamily, maybe sprinkling in more warehouse and storage, things that are going to be needed. And obviously never looked at retail before, not looking at retail today. I think retail, we're seeing what's called zombie companies. And this has always been out there. So the other thing is, I was prepared for a correction 3 years ago. Did not expect this as a correction. Did not expect a Black Swan. I just expected, the market can't be up for 16 years and be up another 16 years. So we were already doing alternative asset classes, private equity, and some things we can talk about. So we were kind of built for this, but not built for how fast it happened. This is now going to be the fastest bear market. I think, depending on the math, we're down 27% off the high in a matter of months. I mean, that is ridiculously fast. And I'm hoping it'll be ridiculously fast on the way up. Again,
can I pause you for a second to jump back on a couple of things? So
yeah,
I just want to jump back. So in case anybody is wondering, so COVID kind of pretty much crashed the markets. I mean, Dow dropped over 25% or about 25%. And I think that's a really good marker of what else happened in the stock market, even though it's only 3,800 companies, you'll say, not the millions in the United States. I think it's a good indicator of what the big companies are doing. And then at a smaller level, at an individual level, maybe you have individuals that are losing their job. We had spike in unemployment to over 3 million last week. Was it 3.5 million? And so, and then you have not only a spike in unemployment because people are losing their jobs, right? What are the top 5 jobs in the United States? Something like administrative or clerical work, or retail work, restaurant or service work. I'm probably going to mix trucking, maybe manufacturing is up there, but a lot of these people are unable to work right now, and many of those companies were laying them off. And then, so those people now have no money to pay rent. 78% of Americans live paycheck to paycheck. 30% of them don't have emergency savings. So then they're laid off. They don't have any extra money. April 1st is coming up. They're not going to be able to pay rent. So you're in a 1031 exchange right now. And in addition to them maybe not being able to pay rent, you have governments that are saying, we're not going to evict anybody for months. So whether or not they have the money to, and so whether or not they have money to pay rent, they just might not. And so you're on a 1031 exchange deal. So it's a elderly couple who has owned a mobile home park. They're looking at selling that mobile home park. It's roughly $20 million. Carlisle is the company that you're using to help facilitate the 1031 exchange.
So Carlisle is the company that's buying so the private equity firm is buying their thing.
Okay.
And the interesting thing is, Carlisle can't leave Seattle. Like, they just can't. The guys that do the people that do the appraisals can't leave.
That makes, so I was jumping in there. So you're actually facilitating the creation of the Delaware statutory trust for this client,
So we don't make them. We do the best of breed out there. So there are companies out there that had registered,
like Cannon,
regulated,
Fitzgerald, and those guys.
Yeah, you got CBRE, you got Inland, you got Pasco, you got companies that this is their space, this is their lane. Their deals had been packaged, months ago to be offered today, and they fill up, and then there's another one. It's almost like a conveyor belt in a good way, because they always have equity coming down the pike. So I would not have felt comfortable if the private equity firm didn't back out.
Right.
I would have felt a little bit. I would not have done. I would not have okayed it. We instead of my client delaying the settlement, the buyer delayed the settlement, which gave us.
So that was a perfect world there, because now you have more time to look at other packages and other offerings, and then you have time to get the updated rent rolls from those offerings in there. Because I wasn't sure if you were looking at, if you had one specific 1031 kind of. If you had one specific package locked in already, and I know you don't have to lock it in until 45 days after the settlement.
But the one we had was based on pre-COVID numbers. So it wasn't equity that we were obligated to buy. I actually unplugged that and said, listen, we're not going to do it. And they knew why. I mean, at the end of the day, my client hadn't yet sold, so he doesn't yet have the 1031 countdown timer of you have to identify, you have to do the, Uncle Sam doesn't always let you not pay capital gains. So if they're going to give you a path to not paying capital gains, it's very narrow, and basically Uncle Sam wants you to step off the path. So we've done this before. At the end of the day, it was interesting to see, a lot of what I do. And I mean, we do private equity, and we use Carlisle a lot for some of our private equity exposure. This isn't that. So it was funny. I told the client that, we're selling, we end up the new private equity you're getting into from the sale of the mobile home park might actually own a piece of the mobile home park you just sold, because we can't control what Carlisle puts in their private equity funds, when we get into them on the other side. So that was an interesting, play out. One of the things that if you can have, one, secret sauce for everything, whatever you have to do to give yourself time to not have to do something in a time where it's not the right time to do it. So there's an opportunity, there's a bunch of opportunities, and getting on the landlord that you were talking about, the landlord issue, there's government programs on that side. And I got an email from my bank saying, hey, take this loan and we're not going to give you free interest. We'll just not let you pay and put it on the back. So a lot of our clients and a lot of our, a lot of smart people saying, listen, I don't need the rent or the mortgage, hiatus, but if I have money not coming in and I'm not having money go out, my situation is just giving me that time. So I'm looking at it personally. I'm looking at it for clients. And say, okay, where are they offering, a limited cost, meaning there's no, not more interest or not a penalty, and it won't affect your credit. If we can do that a bunch of places, we're just giving us that time that we need. Because end of April, early May, our view will be a little bit clearer than it is beginning of April.
Sure.
And especially if things that are supposed to peak are peaking, if some of the numbers come out, most of the unemployment is exactly the services you talked about. They're people that can't get to work or their work isn't open. They're not going to have a job, and they should be on unemployment, and there's a program to support them, but they're also easily reemployed once things start happening. So I think, what we're seeing is a balance of priorities. You have the healthcare system in America that can't handle, everyone getting it at the same time, which no one really could. And then you have the economy that really won't be able to handle if it slows so slow, it'll be too hard to get back up. So it's still, every day there's a new Amazon box on my wife's, on our front step. We're only allowed to open it 48 hours later, but it's still there. So, there are people working. We're working in our office, but we're doing it remotely other than today, and I'm the only one in the office. So I think what you're going to see is there are some places that haven't been impacted at all because of just, space between people. Those places might not have the shuttering that we have other places. And then you have New York and New Jersey, they got to be shut down big time. And Florida has to shut down. There's some common sense stuff, but I think one of the things that we're seeing now is the federal government doesn't always have the rights to do things at the state level. Trump really can't tell you without going through a lot of things and making, National Guard and Trump can't close Daytona Beach in Florida.
He would have to incentivize them to a certain degree.
And they would want to do it. I don't know why the common sense isn't common practice when it comes to a governor closing things that can't be good.
Yeah.
We didn't know Mardi Gras was going to be what it did, but if you look at who went to Mardi Gras and where they went afterwards, that didn't help anybody.
Pretty intense. Can I pause you there for a second, Fred? I want to jump back into 1031. So you have more time now, and you're waiting for updated financials. You're waiting for updated rent rolls. When you're looking at these, obviously now you might want to be cognizant of what their asset management strategies are. And this might be something that you're also working with your clients, but when you're looking for these deals and you're looking at kind of the pitch decks that they're putting forth, these are the asset classes that we're in, here's how we're managing it. What type of short-term asset management strategies are you specifically looking at with these deals? And how do you kind of dictate whether or not they have enough gumph to get through this?
Yep. So the answer to this is also the answer to what are we telling our clients that aren't looking at 1031? Because obviously a 1031 is a point in time in which you have to find another deal. So it's a barbell ideology. And on the one hand, there are places that are super safe. So the only place we're putting money, a new dollar today, if you came, hey, I got $1 million, what are we going to do with it? There's really going to be two broad categories. One is super safe, and that could be a defensive account that's liquid, that's managed on your behalf, that is meant for preservation of capital and liquid income. You're going to get 3 to 4% on that, but it's there for you as dry powder for a later. The other thing you can do, there's companies out there that are doing private preferred stock. So you have a public company, and obviously public stocks are down the 27% you mentioned. Some of those public companies have already offered and are continuing to offer private preferred stock. So the private part of it means it's not tied to the market. The downside is obviously the company's not there when you go to redeem it, you lost your money. So you have to make sure it's a safe and secure company. And the ones we're using, we've beta tested it before COVID and even after COVID, it's still, they have enough on their table and they're, been around for a while. And they're real estate based, and real estate can't go to zero. Heckingers and Channel companies can go to zero. Real estate really can't. It can go down. But then if it goes down and you lose some rent, that's horrible, but you only lock that loss in if you sell it for that the depressed price. So on the one hand, you have super safe that is either liquid and low income, but liquid and safe. So you have dry powder, or a CD type quality where you're making 5-6%, and that's what the private preferred stock. And all we're trying to do with that money is stay out of the way of this turmoil for 5 years. So we can get 6%, 5.5 for 6 years. That's that, for a piece of the money, that's good. Now, the other part of the, other weight of the barbell is we do not put money in anything that isn't a value add. So what does that look like? On the equity side, it's private equity. Private equity, if you remember, Pretty Woman with Richard Gere, he was private equity. And I use that as an analogy, but we all get it. Private equity doesn't buy a company without already knowing what they're going to do to turn it around. So prior to things being on sale today, and they might go down and sale, another 10%, I hope not. The real strategy for owning regular public stocks is holding and hoping. There's nothing you and I can do to make Apple go up in price other than hope that they come out with an iPhone and there's a super upgrade where 300 million people come and get, the next iPhone. That's all plausible, but it's nothing we have any control over. Whereas value add, private equity doesn't buy a company until they already know who they're going to fire or what they're going to change or what they're going to break up or put together to make some real financial value. And that has nothing to do with the stock market. The other thing with private equity, and the reason I'm talking about it is it's time to shine. Most private equity buy public companies off the market. So Burger King, Dunkin' Donuts, this is all already happened and they came back and now they're public. But private equity will buy a public company, buy all the shares off the market and then retool it and then bring it back. When things are 27% cheaper than they were before, now you're going to see private equity buy faster than they were because they're getting a better deal. They were going to buy a company anyway. Now that company is 27% cheaper, you're going to see. And so again, that's a value add. The other place that we're doing is in the real estate space. So some of your viewers probably already do this, but taking a C+ building to a B+ building, there's real value there irregardless of the market. Meaning when rents come down, they're going to come down less for a B+ than a C+, and they're going to come down a lot less than, A+ that no one has any money to buy anymore or to rent anymore. So, you got to look at those trends and say, okay, where's their dislocation? And there's probably over-levered families who bought and owned and run a multifamily that are now in over their head. They're going to sell to companies that their job is to buy these at now fire sale prices and then manage the apartment like a business. Where some of these families that own, apartments for 30, 40, 50 years, you ask why they did it. Well, that's the way my dad did it. Well, why'd your dad do it? Eventually you get the dad, if he's still alive, he's like, I don't know, I just did it that way. But it became institutionalized. And there's companies out there that run it like a real business. And in my mind, we is almost like HGTV, but at the, institutional level, buying 300 doors and then going through one at a time. They need to have cash for that and they need to have the right space. So I think the other place is the best ideas in the wrong location still won't work. So we're very sensitive to where the location is, especially for the real estate deals. It's going to be location because there are some locations that aren't going to feel the brunt of COVID like other locations.
Sure. Have you seen, so in these package offerings that Inland or Cannon Fitzgerald or some of the other companies that you mentioned is putting forth, what are you seeing them now including, and what are you seeing them kind of writing about, just in terms of that acquisition, as it relates to the current state of the market?
So there's going to be one of the biggest dislocations in 2008. Almost all primarily the people, you and I and everyone else and all the families that, the consumer were over levered. 2008, we got our butts handed to us. People went from a McMansion toll brother house to an apartment and was embarrassed. And there's kids that grew up that was their reality. They had a toll brother house one day and then living in an apartment the next day because mom and dad both got laid off and owned a house they couldn't afford, but they got anyway. So the consumer has a lot less debt. Unfortunately, the business sector of the economy decided that, debt's good. And so you see for the last 15 years, companies have used cheap debt to buy their own stock, which made the stock price go up and gave everyone a bonus, including us if we own the stock. They didn't really do anything with the money other than buy their stock. So they didn't always, buy a new manufacturing, and some of them did. But for primarily, if you look at what drove the equity prices, it was cheap debt to buy their own stock. Well, now those companies, the debt's kind of drying up. And so now you have a lot of debt on the books. If you're a company, you can't get any more. The debt you had, you kind of blew through and just did something else with it besides, do something of structural, integrity. So you're going to see what's called zombie companies. And these are companies that look brand new, companies you just shopped at yesterday, go bankrupt tomorrow. And it's a function of they don't have any more debt. They can't absorb any more debt. They're a little bit over levered, and they're going to not be the companies we expect. Like we all saw Sears and J.C. Penney. We all saw that kind of 15 years. We saw that 5 years before they went through their struggles because none of us shop there anymore. We all were going on Amazon or whatever. I think we all feel the Best Buys of the world become America's, show place, and then you look it up on Amazon and buy it on Amazon. I'm not saying it's right or wrong, but we're all doing it. So there are companies that we don't expect to turn around, that we don't expect to fall, and they are going to, and they're called zombie companies. At a high level, it's needed in the market. Like if you're a company and you're not providing the goods and services the most efficiently, from a economic standpoint, you shouldn't exist.
Right.
It's going to be horrible because it's jobs that are gone and people that are losing money. So looking at asset allocation, at the end of the day, adding value is going to, even at a company level, they can add value. So, if a company is doing something that's going to add value regardless of the stock price, we're interested. And you picked on, you talked about this earlier on. Our recipe for where we're putting money has always been where Harvard and Yale and the California pensions already have been. So they have 70 to 80% of their money not in the public market. So they're not down the 27% that the rest of us is, because they're not even in that space. And it's a function of they don't die and they don't pay taxes. So if Cecil figures that out, I'll come work for you and we'll take over the world. But the other part is they're able to do things that have a longer time frame. And not everything they can do can you and I do. They can buy land outside of San Francisco and wait 50 years for it to become San Francisco. Not a bad investment, just not an investment for you and I, something our kids would benefit from. But there are things they have always done. So if your viewers, if you want to know my special sauce, read the annual reports of those foundations and look at most of their money is not in the gambling part of the stock market. Now they do have money in the market, and where they do, look at what they're buying, because if they're only going to have 10 or 20% in the market, look what they bought, because they probably have a lot of conviction behind it.
Sure. So when you're looking at, and if I heard you correctly, so when you're looking at these packages to look at, specifically, maybe it's a shopping center deal, maybe it's a warehouse deal, you're looking at the companies that are involved, and then doing maybe a little bit of research on, who are these tenants, and how are they going to fare throughout this whole market mess? Are they over leveraged, or are they a zombie company? But then also maybe analyzing, well, if a private equity play comes in, what does this look like in the long haul? And will this zombie tenant or something like that in the shopping center or this industrial complex or something like that, will it just be replaced by somebody else? And so you mentioned just buying good assets in good locations and focusing on the value add is really the play. Is that kind of what you're looking at for this mobile home buyer? I mean, for the mobile home
so
seller?
We don't look at, retail's too iffy. Hospitality is too iffy. And that was before, COVID. Hospitality is very finicky. And if you're in a, Aspen or Aspen's hot, but it's seasonal, and so you have a delay of when there's a great space, there's a delay from that great space to all the development that gets approved. And then they all come, they all come online at the same time. So now it's a great space, but there's more supply of hotels or whatever it is. So from the real estate standpoint, looking at, and I had always looked at, and now with COVID, it makes it even more important, recession-resistant allocations. Mobile home parks are not bad, but this was for our clients a fully depreciated 40-year asset, and they're actively managing it. They want to be a seller when it's hot. They don't want to be buying a mobile home park today because they're not making any more. So the supply is really, really diminished. They're good long-term asset classes, which this client, has already lived through. And that's one of the reasons why private equity is getting into it, because it's a good kind of recession resistant. If someone moves out, they don't ever take their house. So now you have an asset you can re-rent. So anything that's value add is something that we're looking at. And then looking at the short-term and long-term trends. Like short-term, there's going to be, rent diminished. There's going to be people out of a job. Long-term, there's two parts of this. And I believe the long-term is things get better. I don't know if you were on the phone call with, you and I were on another phone call, but there's other people whose long-term is, the dollar's no longer the world currency. We're all owning gold and living in,
from Peter Schiff.
I'm not
quite the extremist.
I don't ever count out America or Americans. At the end of the day, our democracy is the, we're the cleanest shirt in the laundry. And it has happened more than once. We both, the two world wars, the crash of 29, things that thought, okay, now the world's over, 2008. The difference between COVID and 2008, in a good way, is none of us knew when and how 2008 was going to end, because it was a systemic issue. It wasn't based on something that a virus has a cycle, virus has a life, virus has a cure. Might not be when we need it, but it'll eventually be there. And with summer happening in America, viruses also like to be, at least this one supposedly likes to be cold. So I think eventually we're going to see an uptick in people's view of what the world's going to look like in the future. Right now it's, we're all stuck in our house. It's like a snowstorm. I'm in the Northeast. It's like a snowstorm without the shoveling, and I don't know when it's going to, when I can go back out. But at the end of the day, no one I know is sick. No one I know has ever had it. We all could have had it in January and not know it. I mean, I had a cough in Aspen, and it lasted 3 weeks, and they said it was a, upper respiratory virus, and I'm over it. It could have been it. We all could have had it. And at the end of the day, I think there's a little bit of this where fear of the unknown, and everyone wants to sell advertising. So all the news is leaning with the breaking news, COVID, 3 more people got it. But you and I all have seen, more people die of a DUI. Well, maybe not now because we're not driving, but there's other things people are dying from still more than COVID, but it's not getting front page news because that doesn't sell, that doesn't make people.
I think, like you mentioned, the uncertainty, and the growth rate around that uncertainty, the contagious aspect. As we wrap up here, I want to ask, what your overall outlook is. And I want to precursor that with, there's thought leaders out there, and I like Ray Dalio. He's one of my favorites. And Ray is suggesting that we're coming up, about 2 years ago, he suggested we're coming up on the end of a long-term debt cycle. And then he's done some interviews recently where he's suggesting that, this could potentially be the pin that gets pulled out of a grenade, coronavirus speaking. So like you mentioned, coronavirus right now, it's the uncertainty that's scaring people, the growth rate. But at the end of the day, it's something that's going to pass. It's going to be catastrophic. It's going to be very sad. We need to, pray for those families or send good wishes to those families that are impacted negatively by it. But at the end of the day, it's something that will pass. But the long-term implications, what does that look like? And you have people like Ray Dalio saying that we could potentially enter into something like what we saw in 1929, 1930.
Yeah, I think it's a plausibility. I mean, at the end of the day, these are all, fuzzy futures. I think it really depends on how we, there's opportunities today that we could, refinancing your current mortgage is something your viewers should be looking at. Now, whether or not they can get the mortgage, because it's a whole other issue, the whole mortgage liquidity. I got in under the radar. It was post-COVID, but it was still kind of new. The only issue is they wanted to come in the house to do the inspection, and I said no. And then now the rules changed that they'll do a drive-by, and I send photos. So there are some benefits we can have on it. My view is, I think, middle of the road. I think it's going to get much worse than it is now, both from a economic standpoint, because we can't save the healthcare and the economy. And right now, healthcare is winning. We're all shut down. We're all, not going into work. And eventually the economists of the world are going to start yelling as loud as the doctors of the world. And then there's going to have to be a hard choice of, okay, now that we've plateaued or now that we peaked, Now that it's summer, now that we have a cure, now that we have more whatever the reasoning is, you're going to see the levers being pushed up from an economic standpoint. And it's going to be phased in, I think, very, very low cases. You guys can do anything you want to do. Pay your rent, go get a job, open up your restaurants, be safe, and be safe with germs and all the other good stuff. And then you're going to eventually see the economy, the issues around the economy are going to, start to I don't hate to hit the word Trump, but start to overtake the medical issues, because that's been worked out, hopefully down the road. So I would also say, ways we can benefit: refinance any debt you have. Look at the opportunities of the debt you already have. If there's an option to delay paying it, especially if you're a landlord and you're going to get delayed getting paid, take every opportunity, as long as there's not a penalty, as long as it doesn't affect your credit. And we're all in the same boat. So I think it all is, doesn't affect the credit, just adds it to the end. So give yourself space, and then look at asset classes you don't already have. So if you were never into the stock market because you had all your money in real estate, stock market's for sale. Don't be stupid. Maybe get an index fund, or maybe work with a manager that can, kind of buy the things that not everything in the S&P are a great deal, but there are pockets of, just like in real estate, there are companies that you could do. I'd also say, look at the things you don't have any of. So if you are worth $1 million or more, you're technically an accredited investor. You should have in your portfolio accredited investments. I'm in Vanguard's backyard, so I'm never going to be cheaper in the mutual fund side or bigger. So our claim to fame is we do the advice, and we do the planning, and we don't care where the money's at. So it can be in your business, it can be in your 401k, but the added to the advice is access. For the right clients, we put them in touch with and give them access to accredited investments. And those things aren't very liquid. So that's why you have to have a certain net worth to be in it. But they have a different risk they have a different risk and return. A lot of times the risk is lower and the return is the same as what it would have been somewhere else, but the risk is lower. And rich people are rich because they don't lose. They're rich because they don't become poor. And it's either because, and I think we all have a feeling of the rich know things the rest of us don't. Not only is that true, but I can tell you it's a government program. The accredited investment strategy, or the rules around that, prohibit me from talking about exact investments in the general public, because I don't know who your listeners are, which is not good or bad, but just even the information about these things is kind of regulated, which is fine. And I understand why, but there are times that my mom and dad, when they were alive, couldn't see some things I were doing that I was putting complete strangers in because they didn't have the same net worth. So work with someone that gives you access to those things. Even if you say no, at least if you know what they're doing, and what's out there, it kind of gives you some perspective. So at the end of the day, I think things will get better. I think it'll be maybe not a V. I would hope a V recovery, but I think a U recovery. And I think we're going to see this in hindsight a little bit like Y2K. Y2K, pre-Y2K was planes are falling out of the sky. Stock market's going to close, take all the money out of the bank because it won't be there the day after. None of that happened. None of that could have happened. Now that we know how it played out, but we didn't know it wasn't going to happen. And so we kind of fed the hype. And I think some of this is overkill. You're going to see a lot of business owners and a lot of the economists of the world doing hashtag restart the economy, because they're seeing it with a different perspective. It's still horrible that people are sick and dying, but if that was going to happen anyway, we don't have to take the economy down with it. And I think there are people that want the economy to, from a political reason, don't want a thriving economy when the election happens. And I'm hoping that's not a lot of people, but I know people that I talk, I'm glad this happened. I'm like, how are you glad that, this is real money, this is real people's lives. And I think the other thing from a future is there's always been a wealth gap. There's going to be a bigger gap because the people that had the wealth to do the right things during this time, including maybe buying into the stock market at a generational historical time, they're going to take advantage of it, and others won't have the money to even take advantage of it. So if you're poor, but you should be getting into stocks, that doesn't help you because you're poor and you don't have the money to do it. So that's not going to help. And I think the other unintended consequences, there's a ton of businesses that don't need their commercial property anymore. All of their workforce is working perfectly at home. They're doing virtual meetings like this with their clients, and they're buying and their prospects. So if you own a commercial building, I would be very, very cognizant of the fact that the demand for that building going forward probably isn't what you thought it was going to be, because the employers are like, you know what? I don't need a gigantic conference room. I can do a virtual meeting and have you do it from, and we're all set up for it. And if you weren't, you quickly got set up for it. And I think commercial real estate's not going to come back from this because of the virtual, all of us, I would say 99% of us don't need to go back to work unless you like the water cooler, but we're not, if you fix cars, you got to go to the garage. Most of us aren't fixing cars. Most of us are in the informational and contact, kind of that's what we do for a living is we provide information and we have to give contact. You can do that without having a real office. So commercial real estate, I think, is going to have a real hard time in certain locations, depending on what the business is. But if you're not a location-based business, you probably don't need as much commercial real estate, which that stuff's already built. It's very expensive to knock down. So maybe those commercial things get redone into, affordable housing or something else because, there's more demand that isn't commercial.
Right. I was looking up a stat here because I think one thing you mentioned, I'll be a contrarian here. And just as we wrap up, I want to be respectful of your time, but I'll be a contrarian here. I definitely think
I'm not going anywhere, Cecil.
Okay. I definitely think commercial real estate will be affected. I think it will be affected by what monetary policy is occurring at a federal level. And I think there will absolutely be a shift like what you're saying. But I did a quick search, and it said the researchers at the National Skills Coalition, a nonprofit organization that promotes investment and training, found that over 60% of workers, let's see here. Oh no, sorry. I'm looking for a stat on what percentage of people work in retail, and service related industries, and for some reason I remember that statistic being something along the lines of when Andrew Yang was running for president. I remember the statistic being like 80% of the U.S. population is employed in the top 5 sectors, which is, retail, and admin, clerical, service industry related. And so I was curious because I think a significant portion of the population does work in those industries. But like you said, the admin, clerical, they might not need an office.
Yeah. So when I say commercial, I'm thinking office space. I'm not thinking retail, restaurants. We will continue to have a service-driven economy, but it's driven by people who are employers, who pay the paychecks, and then we all go out and eat. And it's, Ray Dalio did a great video of how it's all system
the
and
economic
cycle.
Engine.
And that I think your viewers should listen to or watch, because that does show how it spins and the debt spins out there. And I'm concerned about the debt at the government level. Not just our government, but every government. And I think, like, as you said, I think it was always the debt cycle, fixing itself or having a situation was always going to happen. I think COVID sped it. I mean, no one, I'm concerned about the energy companies that were, can't afford to take gas out if it's $20 or whatever. And that's what Russia wants. So you're seeing, again, at a government level, we have other things besides energy to bring to the market. Saudi Arabia and Russia, that's kind of like oil's kind of like their thing. And so they would love it if fracking and the back of fracking gets broken in America, so that they could then, when prices get back and China gets back and demand comes back, we're no longer the biggest, one of the bigger players, which scares me because they will take a short-term devastation to make sure that we have a long-term devastation. Because once a company goes bankrupt, it can't easily come back online, and those capped oil and gas things can't easily come back open unless You
don't think it'll push towards cheaper, less expensive renewable energy sources?
Well, funny thing is, I got a Tesla, and now filling up a gas car is cheaper than filling up my Tesla, which is kind of frustrating.
Is it really?
No, it's almost, it's getting, it did not, I did notice that. I'll just say that, and we're not driving as much anyway. So, my wife hasn't filled her gas car. But that's,
how does that work? They just charge you for the power?
Yeah. You can, I haven't driven it much, so it hasn't needed to be charged much. If anything, it's one of the, again, first world problems. I would love to drive my car, but I can't other than go to work and back because, we shouldn't be allowed out. We shouldn't be out doing stuff. Sure. I appreciate you having me. I know I talked a lot. There's a lot out there. There's on our website, ccwmg.com, there's a whole resource tab. One of the things I did for COVID is put everything that used to be for clients only, just public. So there's from beginners to complicated, whatever it is, there's probably a video about it or an article about it. So that's out on the website, free for anybody. You don't have to log in. I won't even know you went there. And the other thing we do a virtual SOS, second opinion service. So if anyone has any questions about private equity or institutional, we're here to help.
Awesome.
And we have a team of people that are all remotely working, their full-time job remotely.
Cool. And that's ccwmg.com.
Yep. Cat, William, Mary, Greg are the initials.
Awesome. Cool, man. Hey, well, Fred, thank you so much for your time. I really appreciate it. Have a good one.
Take care. Bye-bye.